We'll now sort of come to the interplay of global markets with the Indian markets. We had that big rating upgrade. We're trying to understand what all of that means for the foreign sentiment towards India. Guy Stear is head of emerging markets and credit research at Societe Generale. He is joining us this afternoon. Guy, thanks so much for joining us. Appreciate you taking the time. I'm going to ask you about India first and then put it in the context of what's happening globally. Did foreign investors take note of the Moody's rating upgrade? Does it matter at all?
Well, I think so, to some extent. I think the bigger issue for India is really its position in terms of emerging markets more broadly. We are living in a quite exciting world in terms of the developments over the weekend, so I'm almost immediately going on to the second part of what you suggested we should talk about, which is the broader context. But just putting it specifically in terms of emerging markets, I think some of the concerns are whether the volatility of developed markets can redound on emerging markets more broadly, and India being one of those. I think one of the other questions that people have had about India more recently is that although a lot of emerging markets seem to be having quite strong growth, Indian growth on the margins does seem to be weakening a little bit, and that's been offset by fairly generous policy. So I think another consideration for people is to see how Indian monetary policy is likely to evolve.
Okay, so let me just push that point a little further, Guy. Two questions. One is, so does this rating upgrade make you review India in the context of emerging markets at all? Number two, would guys who are already invested in India, would the foreign investors who are invested in India, would they look at enhancing their investments?
Well, I'm afraid I would say probably the answer to both of those questions is no. I mean, I think there's a little bit of a trend of people to think that the ratings probably follow market sentiment rather than provoke market sentiment, although you can be in a virtuous circle, and that could be part of the issue we face here, or hopefully one of the issues that we face here. But I think, again, I think probably when people look at India just at the moment, it's probably on the policy side that they'll be making their biggest decisions. That and growth in terms of earnings.
All right, Guy, just talking about the broader picture, as you were saying, the question is whether developed markets and the change in the mood there would have any impact on emerging market flows. I think the conversation was around the flattening of the US yield curve. What is your sense of what that means? A, do you suspect that that will continue? And what that could mean perhaps for flows into emerging markets, at least on the bond side, if not on equities?
Well, I think the flattening of the US yield curve always precedes a recession, or almost always precedes a recession. It also the yield curve sometimes flattens without us getting a recession. There's a quote from one economist, which I've forgotten, that the US yield curve has forecast something like 20 out of the last 10 recessions, something along those lines. I don't think I've got the numbers quite right, but you get the sentiment in terms of the quote anyway. So I think that there is concern about U.S. growth, and that makes a lot of sense. It isn't so much about U.S. policy and the U.S. tax situation. I think it more has to do with the level of U.S. profit margins. And U.S. profit margins slowing. U.S. profit margins have also been a leading indicator of economic growth. Every economic cycle is different, and this economic cycle seems to be even slower than economic cycles we've seen in the past. But nonetheless, those declines in terms of U.S. profit margins and the squeeze we're getting as wages go up and companies find themselves incapable of passing price increases onto their customers, that's something that makes people concerned about U.S. growth in the medium term, particularly when we talk about the medium term, not so much about 2018, but rather 2019, 2020.
Guy, we're talking at a time when there is a fairly significant political development that's going on in Europe. Angela Merkel finds her political position being diminished. What does this signify, and how does this sort of influence the direction of how the euro-dollar equation plays out?
Well, Germany is considered to be the principal motor of Europe. It's been the principal motor of European growth for most of the past 4 or 5 years. It's been the principal motor of European policymaking as well, I think somewhat reluctantly, but particularly since around 2011, 2012. So the idea is if we now end up with a caretaker government in Germany, or a government which is really incapable of doing much, then we will have concerns about whether European crises can be dealt with very effectively going forward. Now, having said that, I think most people would realize that the most effective agent in terms of dealing with the European crisis since 2011 has actually been the European Central Bank, not any member government state. But nonetheless, the positive comments that came out of Angela Merkel in particular have been something that has actually helped the European situation. So I think people's concern is that were we to head into another European crisis with more concerns, and particularly people would be looking ahead to the Italian elections coming up next year, they would be worried that the combination of an ineffectual German government and political crises elsewhere in Europe would lead to a situation where potentially the European Union the fault lines could appear very dramatically in terms of the European Union.
Guys, so you put all of that together, the US growth scenario, which you talked about earlier, uncertainty in Germany, Brexit, and of course, we haven't spoken about the Saudi and the oil situation, but that's been playing out over the last fortnight or so as well. It looks like we're ending 2017 and perhaps going into 2018 on a slightly more tentative note than we started this current year.
Well, remember that things were not necessarily that optimistic at the beginning of this current year either. And in fact, I think 2017 turned out to be a much better year than people expected, largely because growth was a little bit better than people expected, and political risk actually had a tendency to abate over the course of the year, despite all the news headlines. I think when we look ahead to 2018, though, we can imagine that the reverse could be true, that we have had quite a lot of luck in terms of the growth situation in 2017. That situation may be reversing. We could actually be seeing the political situation getting more difficult in 2018 rather than less difficult. So I do think that risky assets are likely to have a more difficult 2018 than they had in 2017. The other issue is that we start the year with risky assets, and particularly in terms of developed market credit markets being very expensive. So I think that's also a factor that we need to put into the overall equation.
Guys, Stear, we'll leave it there. Many thanks, Nick, for joining us with your views. Guys, Stear joining us from our studios in Paris from Societe Generale.